afternoon, ladies and gentlemen. My name is Andrew Samwick, and I'm the director of the Nelson A. Rockefeller Center and a professor of economics here at Dartmouth. It is my pleasure to welcome you to this afternoon's program on the 10-year anniversary of the financial crisis, a conversation with Sheila Bair. Our conversation will be moderated by Peter Fisher, a senior fellow at the Center for Business, Government, and Society at the Amos Tuck School of Business. Our event this afternoon is part of the Rockefeller Center's ongoing 35th anniversary celebrations, and I encourage you to visit our website, rockefeller.dartmouth.edu, to stay abreast of our programming this fall. It was a mere 10 years ago, less perhaps 1 week, that we gathered at the Rockefeller Center for an event, part of our 25th anniversary celebrations, on the financial meltdown, causes, consequences, and options. I moderated a panel of 3 of my colleagues from the Department of Economics. I had some appreciation of the factors that precipitated the meltdown, but it was illuminating to hear these experts describe the various ways in which financial market institutions had gone horribly wide of their own self-preservation. I remember hoping that our regulatory and oversight institutions were more squarely focused on their missions, and hoping even more that the people leading those institutions had the knowledge, the courage, and the support to see us through the crisis. By the time we gathered in October of that year, our guest this afternoon had been hard at work in getting high marks for her stewardship of the Federal Deposit Insurance Corporation, where her chairmanship had started in 2006. The FDIC insures deposits in banks and thrift institutions, while the overarching goal is establishing confidence in the United States financial system. The FDIC monitors risk to deposit insurance funds and steps in to limit the economic and financial impact when a bank or thrift institution fails. The FDIC is the primary federal regulator of state-chartered banks that do not join the Federal Reserve System and the backup supervisor for the remaining insured banks and thrifts. It also examines banks for compliance with the consumer protection laws and for meeting the demands of the Community Reinvestment Act. As the financial crisis unfolded, the various elements of the FDIC's mission, safety and soundness, consumer protection, and economic growth and inclusion, inevitably came into conflict with each other. I first became aware of Ms. Bair's leadership style in March of 2008 when she made some astute and pointed remarks about maintaining deposit insurance assessments on banks even in the face of an economic slowdown. And she further encouraged them to bolster their own capital and reserves. Ms. Bair received numerous awards and recognition for her leadership at the FDIC, including the JFK Library's Profile and Courage Award, being twice named by Forbes Magazine as the second most powerful woman in the world, and dubbed the, quote, little guy's protector-in-chief, close quote, by Time Magazine. Ms. Bair's focus on the public interest has been a hallmark of her government career, beginning as a senior advisor to former Senate Majority Leader Rob Dole, a commissioner of the Commodity Future Trading Commission, and Assistant Secretary for Financial Institutions at the Treasury Department. Prior to her leadership of the FDIC, she served as the Dean's Professor of Financial Regulatory Policy at the University of Massachusetts Amherst. Since the end of her time at the FDIC, Ms. Bair has been a senior advisor to the Pew Charitable Trusts, where she founded the Systemic Risk Council, a group of distinguished financial experts which advocates for policies to promote financial stability, and most recently, president of Washington College, where she was a strong advocate for college affordability. She's an author of as well, not just of columns in major news outlets, but the New York Times bestseller, Bull by the Horns, her 2012 memoir of the financial crisis. She has also written books for children on financial matters, including her young adult book on the crisis, Bullies of Wall Street, and picture books on financial basics, Rock Brock and the Saving Shock, and Isabel's Car Wash. Joining Ms. Bair for today's discussion is Peter Fisher, who has for several years taught his course, The Arrhythmia of Finance, at the Tuck School of Business, where he is a clinical professor. Before coming to Tuck, he worked at BlackRock for 10 years in several different capacities, including head of fixed income portfolio management and chairman of BlackRock Asia. From 2001 to 2003, he served as Undersecretary of the U.S. Treasury for Domestic Finance, where he and Sheila worked together. Before joining the Treasury, he worked for 16 years at the Federal Reserve Bank of New York, where he served as manager of the System Open Market Account, responsible for domestic monetary and foreign currency operations. I hope that this afternoon we can learn from two public servants and educators with deep subject matter expertise. What went wrong? How has the policy and regulatory environment changed as a result? What risks are we still facing now at the crest of another business cycle? And what can we do prudently to avoid the next crisis? Ladies and gentlemen, please join me in welcoming Sheila Bair and Peter Fisher.
Thank you, Andrew, for doing the heavy lifting on introducing Sheila. I really appreciate that. I want to add two additional introductions. One about Sheila, which, so she doesn't have to say this. I want to say it from the start. Sheila was worried about mortgages being written to people without enough income in this country before most people knew what a subprime mortgage was. In 2001, 2002, when we worked together in the Treasury, Sheila was very worried about getting people too far into debt that they could not repay, and what it would do to them and what it would do to our financial system. And it took people 5 years, 6 years to catch up with Sheila. I just want to be clear about that before I start interrogating Sheila. I also want you all to cast your mind back to a time before the FDIC was created 75 years ago, and even 150 years ago, when money in our society was scarce. It wasn't obvious where our money was. And as a consequence, most Americans had a deep appreciation about our banking system. I had the opportunity, I forced myself, to go back and look at the Lincoln-Douglas debates. And surprisingly, some of them digress into the minutia of how the banking system worked in 1858. And the idea that Americans out on the receiving end of politicians on the hustings would listen for half an hour or an hour to the minutia of about how the banking system works and what money is, told you something about Americans' appreciation for the subtlety and complexity of where our money is. It's in a bank, and that means it's just a promise. And the question is, can the bankers keep it? And to flash forward to 2001 or 2006, when Sheila takes over the FDIC, most Americans don't get that anymore. They don't understand that money's this very fragile, subtle thing. Maybe once a year they watch Jimmy Stewart and It's a Wonderful Life. But then they gloss over that and they focus on the human side of the story. So the challenge Sheila was up against as the financial crisis unfolded, we're going to run a controlled experiment on how fragile our money is. And nobody gets it. Members of Congress don't get it, and the American people don't get it. And sadly, if you're chairman of the FDIC, you're one of the only people who's got to get it, because you're the person who's supposed to keep the system together. So I want you to see both parts of that as what Sheila's going to confront, and then I want to throw Sheila back 10 years and ask Sheila, what surprised you in 2007-8? What did you not know that you learned in the course of the unraveling of the financial system in 2007 and 8?
Right. Well, after listening to that nice introduction, I would say one of the more surprising things was being named the second most powerful woman in the world by Forbes Magazine in 2008 and 2009. That was like, my press secretary called me and told me that. I thought, what? That's got to be a mistake. I'm going to give you a serious answer in a minute, but just a funny anecdote around that. I went to my daughter's elementary school in 2010 after things had calmed down a bit, just to talk to her classmates. And the principal, in introducing me, said the same thing about being the second most powerful woman in the world, 2008, 2009. So I give my spiel. I care a lot about financial education. It's one of the reasons I've written children's books and making sure kids understand money and banking and where their money is. And so as I finished, I opened it up for questions. A little hand went up on the back of the room, and she said, well, who's number one? So it's very tough to impress kids these days. Actually, I was 2008, 2009, I was second behind Angela Merkel, and then in 2010, I dropped to 14. I was quite devastated. I was behind Lady Gaga. And then when 2011 happened, I dropped off completely, but when I left the FDIC, but I was at the top of the list of people who dropped off. So anyway, okay, now I'm going to give you a serious answer. I had a lot of surprises, and I learned a lot. I think the biggest surprise was just how systematically the entire system failed. I mean, bank leadership failed, regulators failed, political leadership failed, investors failed, rating agencies failed, and borrowers had a role in this as well. A lot of these mortgages were very abusive and fraudulently marketed, but there were speculators out there too. They were taking advantage of situations. So I think just that the fact that system-wide, every check we thought we had against something of this happening, it's like Warren Buffett's famous, the most dangerous words ever spoken was everybody was doing it. So everybody was doing it. And in 2001, when we were looking at it, it was the marginal payers were doing these kind of unaffordable lending, and they were targeting minority neighborhoods, low-income neighborhoods around Baltimore. Ohio was a hot spot. And by the time I came back to the FDIC in 2006, it's just gone mainstream. Everybody was doing it. And I think that's what surprised me the most. I think the other thing that surprised me, and I'm saddened to say this, but the way, again, there's a lot of responsibility to go around on this, but the leadership of these very large financial institutions did bear a good measure of responsibility and the failure of so many of them to accept accountability. And by 2009, after we had these massive bailouts, they were lobbying Treasury to be able to pay back their TARP investments. That was one of the stabilizing measures. We made capital investments in these banks. And why did they want to do that? So they could pay bonuses again. And they paid big bonuses at the end of 2009. And that really surprised, that shocked, more than beyond surprise, that shocked. I was just appalled. So I don't know. I hope people have learned better lessons. But that was clearly one of the more surprising things. It's sad, and I hope people have learned their lessons, but I'm not sure.
What mistakes did we make that we should not repeat?
Yeah.
There are a lot of them.
So there are a lot of them. There are a lot of them. I hardly know where to begin. So I think, and Peter, you and I have talked about this. When people say, what was the main driver? It's really not. It's too much debt. It's too much debt. Homeowners are borrowing too much. But banks, large financial institutions were borrowing too much too. So to have a stable financial system, you need to make sure that the financial institutions themselves are getting their funding. A good share of that's coming from equity, not debt. Because equity is very flexible. So I'm sure a lot of you invest in the stock market, right? So if you invest in Amazon's shares, you don't expect, pick a number, $100. You don't expect Amazon to pay that $100 back to you with interest, right? You understand that share can go up, that share can go down. It's an equity investment, and Amazon has no obligation to pay you that back. Debt's completely different. Amazon's got to pay you back. It's a fixed obligation. It's the same thing with banks. It's inflexible. And when you get into a downturn situation, when their losses start going up, because a lot of them had these toxic mortgage-backed securities and all these fancy structured products that are laid on top of these mortgages on their balance sheet, they had inflexible debt obligations and very little equity to fund themselves. And they couldn't fund themselves anymore, because not only were they borrowing too much to keep themselves going, they were borrowing on a very short-term basis. So they'd have to go, literally, I think I read Lehman Brothers, I think every night, their whole balance sheet would, like 50% of it would turn over. They'd have to go back into the markets and borrow. So when the market was looking at, money market funds and others who would invest, in financial institutions' debt, were starting to see all this distress in the mortgage market. They didn't want to lend to them anymore. And that was a big part of the stabilization measures we used. The FDIC actually had to go in temporarily and guarantee their debt for them, so creditors would have enough confidence to keep lending them money, to keep them funded and keep them stable. So it was too much debt and not enough equity capital to make them resilient. And that's one of the reasons why we had this huge recession, because the other problem with a financial institution, both investment banks and commercial banks, who don't have enough equity capital, is when they start having losses, they're not going to lend you anymore. They got to take care of themselves. They pull back on their balance sheet. They constrain credit. And we had something like $3 trillion of credit lines were pulled in 2009. It was an unbelievable credit retrenchment. The community banks and the regional banks did continue to lend because they had a lot more equity capital. And they also didn't have exposure to these very high-risk assets, mortgage assets that were losing value. But so it was not only required bailouts, but also led to a much more severe recession because they were not resilient enough to keep functioning in a downturn. That's what you want your banking system to do. You want a banking system, and that's why we give them deposit insurance and access to the Fed lending facilities so that they can be resilient, and in a downturn, they can be a source of strength, not weakness to the economy. It was just the opposite in 2008 and 2009. The government had to come in and prop them up, not the other way around. So too much debt. And I will tell you now, the climate in Washington, so a big part of the post-crisis reform efforts under DoddFrank was to require banks to fund themselves more with equity capital, right? Your equity owners should have more skin in the game. We want you to have a thicker cushion of equity capital. So when we get into another downturn, it's easy to manage a bank in good times and everybody's making money and the economy's healthy. What we want you to do is be resilient enough in a downturn. And so we've significantly increased our capital requirements. They're still not particularly stringent. The most important binding constraint requires that they fund themselves with at least 5% equity, right? So 95% of their funding can still come from debt. But I tell you, from the place they started, that was a big jump. And even that requirement now is under assault by politicians in Washington. It's unbelievable to me how short-sighted people can be and what short memories they can have. But absolutely, too much debt was the core of the problem. We do not want to repeat it. If we're going to have a resilient system that's going to do its job of serving the real economy, they need thick equity capital cushions. And that's a lesson I'm afraid that we're forgetting already.
Let me press you on a different mistake maybe we made, and you and I have talked about this, so I know where I'm going with this. We changed the GlassSteagall rules, which separated investment from commercial banking, which said, no, one group of institutions is going to underwrite and distribute and buy and sell securities, and another group of institutions is going to take deposits and write loans, and we're going to keep them separate.
Yeah.
Some subtleties in how we did that. And when you and I started our careers in government, that was the law of the land. There was another law of the land which was subtler, which we mentioned last night, which was the separation of commerce and banking.
Right.
And that actually was regulated by the Federal Reserve and the Bank Holding Company Act. Mm-hmm. And we had a norm that said, look, no, we want to keep banks over here,
right,
and people doing this thing called commerce, we're going to keep them separate. And the Fed's going to enforce that through the Bank Holding Company Act. And the Federal Reserve whittled those down over the decades.
Yeah, they sure did.
Which worries you more as a mistake we made?
Oh, well, I think so there's been a lot of debate about, let's start with, securities and banking and combining investment banking with commercial banking or permitting that to occur. There's been a lot of debate about to what extent that contributed to the crisis. I think with certain institutions like Citigroup, it absolutely was a contributor. But most of the stress was with the investment banks that weren't really significantly into commercial banking. So Lehman Brothers, Bear Stearns, they had teeny tiny little, thrifts, I think, that were not a significant part. So I can't say that the combination of commercial and investment banking was, other than Citigroup, which was a big area of distress, that was a huge driver. I do think the broader problem of kind of this Wall Street mentality meeting Main Street mortgages was a mistake. I think just it was a culture clash, and if everybody got their mortgage from a nice small community bank, that would make me happy. That's not a system we're still going to have anymore. But the problem was, even though that didn't really, technically it was investment banking because they were providing funding for securitization and partnering with some of the big commercial banks to do that. It was a culture clash in a way where mortgage borrowers were just, looked like little numbers. I mean, there was these huge institutions were funding this. They knew there all the financial incentives. They paid more for the higher risk mortgages, right? So the worse credit you were, the higher interest rate that the mortgage originator could charge, which meant the fatter, securitization fees that the securitization firm could get. So the incentives were all to do volume and do the highest risk mortgages possible. And nobody was looking at this at a human level, right? So your local banker will know you, and they'll know whether you can afford your mortgage and whether you paid your past or whatever. And they're going to go through some kind of thoughtful underwriting. But these banks had a completely different mindset. And so I do think that was, that really wasn't GlassSteagall, but I think it was a culture clash that was quite unfortunate. Independent of the issue of whether mixing investment and commercial banking drove this crisis, I think there is an issue of just being too big. So we talk about too big to fail, but what about just being too big in terms of political power? So I've been around long enough to have worked in the Hill and worked in Washington when we still did separate commercial banking from investment banking. And there was what I thought a pretty healthy dynamic. They fought with each other constantly. So if the commercial banks wanted to get into the securities business, John Dingell, who was the chair of the Energy and Commerce Committee, who had jurisdiction over securities, said, no way. And if the securities firms wanted to expand into commercial banking, the House Banking Committee would say, no way, that's our turf. And so they had their competing constituencies, but they kind of offset each other and limited each other's power. Once you repeal Glass-Steagall, they became one big lobbying blob. I'm sorry, but they were. and you're still seeing that now. They've got tremendous power. And that's why we're those who support stronger capital requirements and other key reforms are in this rearguard battle again, because the lobbying power is just too substantial. And it goes beyond. This was the case in 2006, and I fear it's too much the case again. It's the money. It's just not political contributions. It's think tanks, it's academic research, it's philanthropies, the money is everywhere, because when you have that kind of market power, that translates into substantial political power. And we kind of created this when we got rid of Glass-Steagall.
I'm going to still press you. See, I think if we hadn't broken down the barrier between commerce and banking, it might not have mattered. But
So you say go all the way. So let the big tech firms buy banks.
No. I'm saying the opposite.
Oh.
I'm saying once you wear down the barrier between commerce and banking,
Right.
within the financial system, securities versus commercial banks are small potatoes. Once
that's
you've
true.
let the big commercial bank holding companies do everything under the sun.
Right.
So that's one set of tensions,
Right.
and it's not. I'm just pointing out it's not all on Glass-Steagall.
Yeah, no,
the
absolutely,
fact
I
that
agree with
Citigroup
that.
got so big.
Absolutely,
Citigroup is
absolutely.
big because the Fed changed the
Well,
rules
the Fed let that
about
happen. Yeah, they did.
commerce and
They
banking.
they absolutely
right?
did.
But that's
yeah,
why
yeah.
Citigroup was so big.
Yeah, no, they did. They before Congress acted, they absolutely had started eroding it. That's very true.
Another change in the landscape. I wonder if you think it was a mistake or inevitable. If you go back to when you and I started our careers, people in the room some may remember this, and many will have forgotten. We had a prohibition on interstate banking.
Yes, we did, yeah.
That is, when I had to open a bank account in Washington, D.C., the first time I got a job there, it was like going to a foreign country. What? You're from Massachusetts? We've never heard of it.
Right.
Whereas today you go and take your money out of the ATM machine. Who
Right.
needs to open a bank account when you
Right.
go get a job in Washington? But in that environment, I want you to think about that, audience, and Sheila. Fannie Mae and Freddie Mac had a very unique role. They were the ones recycling capital into the housing market across state lines.
They were, yeah.
And it was something that only they were doing.
Yeah.
Citibank couldn't have a branch in Chicago. West Coast banks couldn't have branches in New York. So the banking system didn't get to recycle capital in the housing industry in particular. And so it fell to Fannie and Freddie to do that, and that was their niche.
Right, it was.
Then we took away that niche for them
We did. That's true.
through over the course of the early 1990s, and the interstate barriers came down.
That's
And
right,
so interstate banking is another change. Do you think it was a mistake to go interstate banking, or is that just the course of history?
Yeah, no, I think I think that was inevitable. I think, and that fostered some competition that I think that was helpful. I would say on the larger issue of Fannie and Freddie, I agree. Once we let It all comes back to a matter of regulation, and you have to understand, another lesson learned is self-regulation doesn't work. Actually, that's not a lesson I learned. I never believed in it. But you need regulation of these entities, whether it's a Fannie and Freddie that have these implied government and direct lines of credit, or a bank that has insured deposits and access to the Fed and implied, too big to fail, which the market kind of assumes. You need regulation. And all of this is going to go awry if government doesn't recognize that they need to be policed. And I think we just forgot that. I would view that as more of the culprit, and that was true. And again, it gets back to a lot of the political power of Fannie and Freddie were enormously, they play the game in Washington better than anybody. The banks learned that and started playing it too, which is why they got all these, this whole series of deregulation that gave them so much of the latitude they had in 2008. But you need regulation, you need capital requirements, and Fannie certainly didn't have much in the way of capital requirements, as you recall. I think it was like Congress said it was 2.5% or something. That was big. So no, I think it was a regulatory breakdown. I don't. Isn't that a related question? Do we subsidize housing too much? Do we worship homeownership too much? I think homeownership is good in the traditional sense of helping build an asset. We started using mortgages as a way to strip equity as opposed to homeownership as a way to build equity. I think that was unfortunate. But do we need all the subsidies for it? I don't know. Do we need Fannie and Freddie? Do we need the mortgage interest deduction? We provide a lot of subsidization for mortgages, and has that too much skewed economic resources into that sector? We're creating a broader drag on economic growth. But I do think homeownership is important. It gives people, asset ownership, gives them a buy-in into the market-based system. And I think when people lost their homes, and the government's response was so heavily skewed towards the banking system and not so much for homeowners, that I think that created a cynicism that is still reflected in some of the political divisiveness and populist resentment that we see today, because the banks got bailed out and the homeowners didn't, and they by losing that home ownership, that was the piece of this system that they got, right, and they lost that, and I think it made them even more cynical about our market-based system. And young people I talk to, and I'm still a capitalist, I believe in a well-regulated market, but I believe in capitalism. But I talk to so many young people today, they don't believe in capitalism.
Well, let's expand on that. You're a nice Kansas Republican, moderate, believe in markets and capitalism.
Right. Yeah, I do.
And
I
you
still
are
believe in
saying that, you're sounding like this tough regulator.
Yeah.
How do you reconcile those two impulses?
I don't think I think markets need to be policed. Even Adam Smith thought that banking needed to be regulated. Even Milton Friedman thought that banking needed to be regulated. Hey, banking needs to be regulated. I mean, the reality is, it's just, the nature of it, the importance of it to real economic growth. I mean, all aspects of the economy need credit. And when you have these government supports that you need to make the system continue to function at a downturn, but that increases the incentives to take risk at taxpayer expense. So no, I think things like deposit insurance, they absolutely create a market distortion. I think on balance, it's still good to have, because people need peace of mind. They need a place. They can keep their money. They know where their money is. They know their money's protected. They know it's going to have stable value. They know it's there to pay their rent, to their mortgage, the doctor's bills, whatever. And deposit insurance gives them this, but there are absolutely trade-offs in terms of creating incentives for institutions to take risk with other people's money. And so you need robust regulation. You need smart regulation. You don't need bureaucratic regulation. You can have the appearance of regulation that's not very effective. But things like tough capital requirements, absolutely. You need that to address the distortion that's otherwise caused by these government supports.
So back to the dark days of 10 years ago, 07 and 08. What did we, collectively, the powers that be, get right?
Yeah.
Were there any profiles in courage?
Yeah, so I think what we got right is that we had a very dire situation, and we had a lot of broad disagreements about what was causing the problem, what the right solutions were. But we all kind of held our nose and came together and did act. The Treasury, the Fed, the FDIC, we did put together a package of measures that in retrospect, well, even then, I think, were probably more generous than they should have been, and we dialed some of them back. But I understand the sentiment by the Fed and the Treasury. They wanted to throw a lot at it because they weren't sure how serious things were, and they didn't want to undershoot. So we threw a lot of money at it. But the important point is we did act. We did make a decision. The system didn't. The financial system did not become unraveled. Now, I think the broader question is, so the short term it was stabilized, the longer term is that really a system we wanted to save, right? Given that, kind of back to same old, a little more capital, a little better liquidity, a little better regulation against risk-taking, but we still basically have the system we have. We've had a very uneven economic recovery, and I think a lot of that stems from how the decisions we made in 2008 and 2009, when we didn't break up banks, we didn't reduce principal for distressed homeowners. We stabilized what was already probably a bloated system, let's face it. The financial sector had grown unbelievably large. It would have been good to break up a couple of those banks and downsize the sector. So we didn't do any of that. So I think that's a separate question of whether this is the right system that we saved. And, I'm very concerned now because I hear some of my former colleagues talking about, of all things, more bailout authority. They're like, their top priority now is that the government needs more bailout authority to make sure that when the next downturn comes, if we have a crisis, there's even more authority to bail out the banks. And I think that's absolutely the wrong thing to be saying. And if what they're saying to me and the public is, we have a system now where we think there's going to be another crisis, you know what, we're going to have to bail them out again. Well, I don't want that system. You want that system? Break them up. Break them up or nationalize them, one way or the other. But to have, what? You're all taxpayers. Why do we want to do that? I think that's a real question. Did we save the right system?
No, I want to press you because I'm not. We don't have to. Do you mean bail out the depositors or bail out the equity holders?
Well,
I want you to parse
so
that point
as I
more
understand, depositors have protection up to $250,000. That's a commitment made, and they absolutely need to be protected. I don't think equity shareholders should be bailed out. I don't think unsecured creditors should be bailed out. They would be wiped out in a bankruptcy. They should be wiped out. So there's a new, what's called Title II resolution in DoddFrank, which basically is a bankruptcy type process to deal with a failing large institution. We did not have that tool during the crisis. We had, the FDIC had authority to resolve the subsidiaries that had insured deposits within these larger banking organizations, but there was no way to resolve the entire organization, and certainly no tools for an investment bank. And that's where a lot of the distress was. So we have those tools now, and they specifically say shareholders and unsecured creditors take losses. And that's absolutely the right thing to do. I think the debate now on bailout authority is whether the Fed should have authority on a one-off basis to protect those equity holders and bondholders. And no, I don't think they should. I think if an institution is mismanaged, whether it's a Bear Stearns or Lehman, whoever it is, they should go into a Title II restructuring process, and their stakeholders should take losses just as they would in a bankruptcy process. And I think not only is it important to have that in place, but to signal, instead of telling the public, we need more bailout authority, it may be coming again, we should be saying to the financial sector, you know what, we have tools now we didn't have in 2008, and if you do stupid things, get yourself in trouble, you're going to go into this Title II. Your shareholders, your debt holders, they're going to be probably wiped out. At least your shareholders will, and debt holders will take substantial losses. DoddFrank also says top management loses their job, board leadership loses their job, they lose 3 years of pay, gets clawed back automatically. It's a very harsh process. If we had had that in place in 2008, do you think Dick Fuld, who was the CEO of Lehman Brothers back then, who had multiple opportunities to raise capital or sell himself, didn't want to do it, banking on a bailout, do you think we would have had the same result? I don't think we would. I think he would have sold his bag for a song, because that's all it was worth at that point. And knowing that the alternative was Title II, I think he would have resorted to self-help. And at the end of the day, as I've said before, we need more Peter Fishers doing things like long-term capital management, because you know what? Long-term capital management, probably a lot of you remember, a hedge fund got itself in big trouble, very interconnected with the financial system. Peter knocked heads and said, you guys take care of it. And they took care of it. You didn't have to put a dime of government money in. And that's the kind of backbone and spine we need from our regulators. And we need them to signal willingness that these tools are there and they're going to be used.
In addition to Title II, that is the authority to take a big financial institution and resolve it, force it through a form of bankruptcy.
Right.
What else that we reformed is really important to keep? I mean, not all the bells and
Yeah,
whistles, but like
yeah.
what as
Well,
important as Title II?
Yeah, I think the higher capital requirements are absolutely essential. I think the Title I, which requires banks to engage in resolution planning, is important. We joked these large financial conglomerates they had gone through so many mergers and acquisitions. Their legal structures were just indecipherable. We joked at Citigroup, we couldn't find the bank in Citigroup. It was basically a place to book assets. There was really no entity there. And so Title I has forced them to come up with organizational charts and identify what their legal entities are and what those dependencies are, so that you do have a viable plan to break them up if they get into trouble. And I think they complain about it, but I think those are tools we had. And will you actually follow what their Title I resolution plan is? Probably not, but at least you force that decision making. You have the information about the legal structure and what can, how you can hive it off to break it up, I think is important. We didn't have that. It was very difficult. We Citigroup, they asked us to ring fence $300 billion of assets. So that was one of the bailouts. We did multiple bailouts for Citigroup. And so one of the things they wanted us to do, they said they had $300 billion of bad assets. So they wanted the government basically to ring fence that, and be willing to take the losses on it or share the losses on it. So, the other regulators wanted to do that. So I said, okay, what are the assets? They couldn't have identified the assets. We announced that ring fence. We took that ring fence off. They still didn't know what assets were in there. It was ridiculous. But it was just, the level of management at the top, understanding what was actually inside the organization, was another big surprise, was astonishing. So we do that tool now, and that's important. I think those probably are. I think there were a lot of helpful things on derivatives, requiring that derivatives be put through most derivatives, not all, but the derivatives that a central clearinghouse will accept have to go through centralized clearing now, which is most of the market. So you have that, and that's important because, again, before most of these derivatives were one-off bilateral relationships. A lot of the risk of them was concentrated in an AIG that was very poor, wasn't regulated, and very, very thinly capitalized. So forcing that central clearing, I think, is an important part of DoddFrank. That also means you need good oversight of the clearinghouses. It could be, if you have a poorly managed clearinghouse, that could be a bad thing, not a good thing. But hopefully the CFTC and the SEC are making sure that those clearinghouses are prudently run. So I think those are good things. They had the Volcker Rule, which unfortunately got riddled with a lot of exceptions before it became law. And it's hard, but the idea of the Volcker Rule is one I fully embrace, which is if you're in the safety net, if you've got deposit insurance and access to the Fed, you shouldn't be using that money to speculate for your own account. And so it's called prop trading. Problem is, it's very difficult to distinguish prop trading from market making, which is legitimate to make market for customers. So there's some complex rules around that. And they're hard, but I think we're better having them than not having them. And so, and again, it's just made boards and top management more cognizant about where their trading profits are coming from and whether they're doing prop trading or whether they're doing customer accommodation. The London Whale is a good example. Sorry, I don't care what Jamie Dimon says, that was prop trading. So hopefully JP Morgan Chase has learned their lesson, but I think those are all helpful things. There are some unhelpful things in Dodd-Frank too, in terms of they actually expanded the bailout authority. So by requiring centralized clearing, they also gave the Fed authority to do bailouts of clearinghouses. So I didn't think that was such a good idea, but that's in there too.
Let me ask a different kind of question. I'll give you an example, which is, are there any wrong lessons we've learned over the last 10 years? That is, things we've learned that we think that we're behaving in a way that is probably a boo-boo. And one of mine, just to illustrate, is you can't de-lever by borrowing more money.
No kidding, yeah.
And yet, that's kind of what monetary policy has been trying to get us to do. We're going to de-lever by making debt cheap. And it's kind of a goofy lesson.
It didn't work.
But
So
are there other
shifted,
lessons you think, or you want to elaborate on
well,
that?
I do think that, I just echo that. I think, if you look at government debt, corporate debt, non-mortgage consumer debt, they're all at historic highs, both on a nominal basis as a percentage of GDP. So corporate debt and government debt, really. So we never really delevered. The debt just shifted to those two sectors. And even mortgage debt, you're seeing starting to tick up a bit. So I think that was a huge mistake that we made, and that the core driver of the crisis was too much borrowing, and now we've tried to use too much borrowing. to get out of it. And the problem is it's also created I think it's one of the reasons that we've had such an uneven recovery, because by relying on monetary policy to fuel economic growth, there's really, so much borrowing you can do. And what it ended up doing was inflated financial assets, because it made equities in particular look pretty attractive compared to those low interest yielding bonds that you might buy. And then it allowed corporations to go out and issue a lot of debt and do dividends and buybacks, and that gooses share prices. But the Fed acknowledged that financial asset inflation, especially in the stock market, was a desired outcome, that they thought we get the wealth effect, that would stimulate more consumer spending, and it didn't really work out. It helped rich people, and they got richer, and Godspeed to them. But it wasn't really by the sweat of their brow they got richer. It was because of the Fed's monetary policy. So I think historians will look, again, back on that not very favorably. In terms of other things we didn't really learn or mislearned, I think the non-bank sector, we still haven't gotten that right. And we, after the S&L crisis, the same thing, we really cracked down on the banks. A lot of risk went outside the banking sector. And I fear that a lot of credit intermediation, a lot of providing credit to the economy now has gone to non-banks. And that's not regulated and not as transparent. So there were tools in DoddFrank to deal with that, but the government kind of shied away from it. There was something called Title I designations, where a big non-bank like an AIG could be designated and subject to Fed prudential oversight, but that's pretty much gone by the boards. And there was something called Title VIII of Dodd-Frank, which empowered the regulators to regulate activities that presented systemic risk, done by non-banks, but that pretty much hasn't been done either. We used it a little bit for money market fund reform, but that was about it. So I worry, in terms of an unknown risk, I do worry about the non-banks now, what's going on there, for sure.
I get to ask one last question before I open it up for the audience to ask you some questions. And you've got college-age children, approximately.
I do, yes.
So thinking of them,
Yeah.
Are you an optimist or a pessimist?
So I think I'm a realist. I see a lot. I'm optimistic on financial technology. I've been fighting this battle for so long. I'm losing hope that government's ever really going to effectively deal with financial concentration of power and too big to fail. But I do think technology has, if done right, has a tremendous potential to, break up what we call the rent seekers, to create more efficiencies, lower costs for consumers, get financial services to them without all these frictions, whether it's checking account fees or network fees or overdraft fees or whatever you may be paying to get basic financial services. So I am optimistic on that, and I think, it's still nascent technology, but I think I'm optimistic that can make our financial system eventually better and more resilient. But near term, I'm not optimistic. I just, back to your point, Peter, there's just so much debt again. Our fiscal situation is quite constrained. The Fed's trying to raise rates mainly so they can lower them again when the next downturn comes, but they're not going to have a lot of flexibility there, and we got no flexibility on our fiscal situation. So yeah, and so you've got this huge national debt. It's growing exponentially as far as the eye can see, and then you've got 1.5 trillion of student debt that we're putting on our kids to finance their education. So no, it concerns me a lot, and I'm trying to do more work in the student debt space now and promote policy alternatives to debt as a way to finance education, and in the near term give students better tools to help them understand and manage any kind of financial obligation. I tell you one thing, if I could do one thing quickly on student debt, is stop calling it financial aid. Oh my God, why does the government call that financial aid? It's a loan, you gotta pay it back. Like, we're doing you a big favor, we're lending you this money at 6% of what I can believe the interest rates is being charged too. So yeah, I think more education, and I think schools need to have their feet held to the fire too. A lot of these tuition increases, they get it mad at me when I say that. Present company excluded, of course. But, tuition has increased because it could increase, because kids could keep borrowing more to pay the higher tuition. And there's not been enough discipline on the schools themselves to hold the line on tuition costs and be smarter and more efficient about how they spend their money. So yeah, and in the near term, I see a lot of burdens we're putting on our young people that do not make me optimistic.
Oh dear, we should have flipped that. We should have done the pessimist thing first, and then you should have been the optimist about
Sorry,
technology.
sorry. Yeah, we should have, you're right.
Anyway. All right, I'm going to open up to questions now, but I'd like to hear from students first for the first 15 minutes or so. Let's see if we can get students who've got questions, and then we'll move up the age scale toward people more than my amount of gray hair. So students, please. Questions for Sheila. And I need you to take a microphone, raise your hand, get a microphone, identify yourself, ask your question. Here we got a question way over here.
Hi, my name is Kyle. I'm a freshman here at the college. I have a couple of questions, but I'm only going to ask one.
Okay.
You said that we focus too much on monetary policy for the recovery.
Right.
So what was your view of the fiscal response then?
Yeah.
And so I took that to mean the stimulus.
Right, you're right.
And if you would have been in charge, what would it have looked like?
Yeah. So I was disappointed in the fiscal stimulus package. I think a lot of it was not money well spent. A lot of, the rebates and things, taxes, Social Security, it was helpful to people, but it mainly went into pay down debt or went into savings, right? So it didn't stimulate consumption, which is really what we needed. I was disappointed that it was short term. I think long-term infrastructure investments, we needed to do that anyway, and it would have created more jobs, I think. So this shovel-ready thing, I never understood that. So yeah, I think we could have done more. In fairness to the Fed, they're using the tool they have, monetary policy. It's a poor tool for what we needed to do, but given the lack of effective fiscal response, I think they felt burdened that they had to keep doing this because it was the only thing they could do. So I understand why they did it. I don't agree with it, but I understand. But even now, we could, even on a revenue neutral basis, for instance, tax reform. I worked in the Senate for Bob Dole in the 80s. And we did the tax reform bill of 1986, and we pretty much got rid of almost all the special breaks, lowered rates on a revenue neutral basis because lowering the rates was paid for by closing loopholes. And these loopholes create frictions in the economy. You create a special break for, whatever it is, money's going to chase that. You're going to, well, I can lower my taxes if I go do that, whether it's a good idea, a good productive use of economic resources or not. And there's a lot of studies that show economies, and we saw this in '86. You lower the rates, but you pay for it by getting rid of the loopholes. That can stimulate an economy without spending a dime. We've never had, since 1986, the political courage to do that. Since '86, keep piling special breaks back on, especially in the corporate code. And it was such, I agreed we needed to get the top corporate rate down. But how many companies are out there paying 3, 4, 5% income tax because there's so many loopholes? Well, close loopholes at the same time. GE's paying 4%, make them pay the 20% or whatever it is you're going to be taking the top rate down to. But they did a few things, but for the most part, they kept the loopholes. They created a new one with pass-throughs, which is a nice break for commercial real estate. Who do we know as a commercial real estate developer that might be benefit from that? So I'm disappointed. I worked in the 80s there where we had that World War II generation, and I had a treat working for Bob Dole. He was a good, effective leader, a very strong public policy orientation, and it just disappoints me now because I think there are things, even within our fiscal constraints, infrastructure spending, I think, would pay for itself longer term. And we talk about our international competitiveness. Yes, there have been some unfair things in some of these trade agreements. Okay, let's correct those. Let's do it smartly. But let's also recognize it's a global economy and we need to be more competitive. And good infrastructure, a streamlined tax code, an educational system that's geared towards our labor market needs, the ability to get re-educated, given how technology is changing the workforce and the skills you need so quickly. Those are the kinds of things we need to focus too if we want to be globally competitive and continue our leadership. And you don't really hear much talk about these days, and that requires political leadership, and we're just not seeing it really right now.
I can't resist to embellish Sheila's comment by asking you to consider the counterfactual on your question about monetary policy. So think about the first 2 years of the Fed's response. You have to liquefy the banking system and avoid asset prices falling. And then for another 7, 8 years, they keep pumping up asset prices with expanding their balance sheet. And the question is, how do we know if it worked? And we don't have the counterfactual. We don't know what life would have been like without it. But actually, we've been blessed by two great economists who wrote a history right at the beginning of the crisis, Carmen Reinhart and Ken Rugoff at Harvard, 800 Years of Financial Folly. They studied 100 episodes of severe financial crisis over 800 years, and their conclusion, it takes 8 to 10 years to recover. And none of those 100 involve quantitative easing. So we have 100 examples across 8 centuries of it taking 8 to 10 years to recover from a financial crisis, and one in which we use quantitative easing, and it took 8 to 10 years to recover from a financial crisis. So it's just worth pondering what difference it actually made.
What is that called, that history?
It's called It's Different This Time.
Yeah.
Rugoff and Reinhart. They've been writing books together for a long time, and they always swap which one name comes first. It's very sweet of them.
Well, there was a fast recovery for the top 1%. Actually, it's more like the top 0.01%, but the rest of the country kind of had to wait for 8 to 10 years. That's true. Yeah.
Their history looks at the
Yeah,
discipline
no, I got
data.
it. No, I
All
couldn't
right,
agree
other
more.
students with questions. Hands up, please. Questions for Sheila. There's a question in the back. We need a microphone. Thank you. Identify yourself.
Hi, I'm I'm Matt. I'm a student at the Tuck School. I was wondering about if you have any thoughts on reconciling what seems to be a discrepancy between a more logical academic understanding of these problems with the reality of them. It was noting
Right.
that you saw this coming with the issues, and yet it still happens, and over 800 years, it keeps happening again and again. And
Yeah.
you think at a certain point, the financial system would be so strong, we'd understand it so well, that the banking system would be perfect.
Yeah.
Why do you think that keeps happening, and what do you think people need to understand with either within society or within the industry to prevent that from happening so badly?
Yeah.
That's a great question.
It is. It's a really good
Good luck.
question. Yeah. So you would think we would learn. I mean, again, I think getting back to my earlier comment about there's too big to fail and there's just too big. I think the financial services industry has proactively tried to be influential in academic circles as well. It's not so much capture, it's what we call cognitive capture, and you see it with the regulators too. And if your sources, your data, and your experts are all people who have the same worldview of the financial system, and we don't need a lot of equity capital, and we'll self-regulate and let us do what we're going to do. You hear that enough, and then if you're getting grant funding or whatever, and there were plenty of celebrated examples of very distinguished economists saying some really silly things about the financial system, because they were doing grants and things like that. So I think it's up to college administrators, university administrators, to make sure you've got good rules in place around sponsored research and disclosures, and discourage it if I were them. I mean, it's okay to take grant funding as long as there's no strings attached, but it's not specific to any particular project. But I think that's part of the problem. And but there have been good academic voices out there, even prior to the crisis. There were a number of distinguished academics that were raising their hands, but they were silenced by the larger kind of groupthink. And I think regulators play a role too, and the Fed, and the fact that, and this, let's face it, the Fed, the Treasury, pretty much all of our expert institutions were also saying, hey, it's fine, right? So when you get that, it takes a lot of courage for an academic to raise their hand and say, I don't think it's fine. Who was the Indian economist at Jackson Hole? Yeah, who did it in 2006, and Larry Summers just completely took him to task. And so if you're an academic, you see that and go, well, I don't want to be publicly embarrassed by Larry Summers. So you think twice about raising your hand. But I hope they will keep raising their hands, because we need good academic rigor on this and calling things out for what they are.
Yeah, I'll just add, I mean, I've seen some of my students here and they can roll their eyes, but humans, we have extrapolative expectations. We think current conditions are going to continue longer than they will. And it's just deep in our cognitive makeup. That's one problem. Another problem is how hard it is to understand balance sheets and leverage in particular. The leadership of the Fed in 2007, as the crisis began, announced that we could not, as a country, suffer more losses than the decline in value in house prices. That betrays a complete ignorance of leverage. That if you borrow money, it's worse than just losing, the house value goes down. And if you put leverage on top of leverage on top of leverage on top of leverage to the financial system, you multiply the loss. It's not just the decline in house prices. And so our extrapolative expectations and the subtlety of grappling with what leverage really means escapes many people. And sometimes it matters and sometimes it doesn't.
Yeah.
Right? That would be, I would
No,
add to Sheila's.
that's absolutely true. And we were, as bad it was, it actually, well into 2007, the market started turning in 2006. Delinquencies in subprime variable rate subprime were significantly escalating. I was still fighting off these Basel II capital standards that if we hadn't fended them off, we did quantitative impact studies that showed a median capital reduction of 30% among the major U.S. banks, most of that against mortgage exposures, because they were all model driven. And you know what? Mortgages don't default, right? So the models were saying, oh, mortgages are safe. You don't need capital against mortgages. I testified in March of 2007 with a Fed staff member, and we were being taken to task for not having mortgage lending standards by the House Financial Services Committee. And I had pointed out that probably since 2001, I've been advocating for the Fed to write mortgage lending standards. And the Fed witness sat next to me completely straight-faced, and she said, well, we're working on revolving credit right now. We're going to update those rules. And once we update those rules, we're going to get to this mortgage problem. But we don't want to constrain credit. I mean, that was exactly what I'd heard from a bunch of mortgage banking lobbyists in my office a couple months before. They were unhappy with me for calling for mortgage lending standards. So when you see, the institutions that you look to for expertise in this are making public statements along those lines, it's very hard for anybody to speak up. And that's why, and now, I'm getting a little bit of that now, so I'm very forcefully arguing against reducing our capital standards. And there's some proposals at the Fed to do just that, and then there's congressional pressure to do even more. And a lot of people I'm hearing about, oh, well, the Fed they're smart people, Jay Powell, Randy Quarles, they're smart people, they're quality people, they know what they're doing, you can trust them. I'm sorry, of course they're smart, quality people, I respect them tremendously, but don't counter my arguments with they're smart, don't say anything, give me an argument back, right? At least acknowledge and respond, but you're getting that same thing again, just default relying to these credible institutions for the truth without taking them to task and saying, why are you doing this? Why does this make sense?
More questions? Here, microphone in the back there.
Thanks. Hi, I'm Vibor. I'm a senior here at the college. So you talked about the benefits of small community and regional banks earlier in your talk. I was wondering if you think that DoddFrank has put undue pressure on those very banks.
Yeah.
You've seen a rise in consolidation in these banks. I'm wondering if you
Right.
think the added compliance and regulatory overhead has caused a very decline of those.
I absolutely think the regulatory response, a mistake, was that the regulatory response came down too hard on the regional and community banks. They weren't perfect. We had probably about 365 community bank failures, I think, while I was there. It was over, we had 6,000 or 7,000, with a lot fewer now, but there were 6,000 or 7,000 at that time. So it was a very low percentage of community banks that got into trouble. Or smaller institutions, a lot of those were thrifts that were doing small thrifts that were doing mortgages on the West Coast, and then some commercial banks that were doing out of region commercial real estate lending. So they made mistakes. I don't want to suggest that, but they were not drivers of the crisis. And there are plenty of regulatory tools we have already for smaller banks and regional banks. The tools we had for traditional banks were quite adequate. And so we did need extra tools for these very large, complex organizations, and that's what enhanced prudential standards, trust testing, that was all about. But then DoddFrank spread that out to basically, really, there were additional layers of requirements for anybody over 10 billion, and then if you're over 50 billion, you're actually deemed systemic. And that did put a disproportionate burden on the smaller regionals because these administrative costs, if you're a JP Morgan Chase or BofA or whatever, you're huge. It's a much smaller percentage of your budget. It's a big chunk of change if you're a smaller institution. So I actually, on that piece of it, surprises people because I do support smart, effective regulation, but raising that automatic trigger for systemic status, I think they raised it to 250 billion. You can still regulate, there's still plenty of regulatory authority for institutions of any size if they have deposit insurance, and if it ends the automatic trigger, so the Fed still has flexibility to put additional requirements on if they want. But I actually think by taking the systemic designation down that low, you diluted the effort for the really top-tier banks, which is really where the risk and dangers lie to the real economy. So yeah, I would agree with that, and that saddens me that happened, because I do think it has helped feed consolidation among community banks, and we need those smaller institutions. I think one of the strengths of our financial system, our banking system, is you have choice. You can go to a community bank, you can go to a big bank if you want, but we need to preserve that choice, and regulation shouldn't drive consolidation. I absolutely think it has.
More questions, please. Anyone, regardless of age. Let's see, we open things up. Yes, there we go. Oh, I got one over here, but
Okay.
there's the microphone first, and then here second. All right, so yes, sir.
Okay, as a reporter covering real estate in the Bay Area in the 2000s, San Francisco Bay Area, and trying to understand why house prices were continuing to appreciate after the area had lost 400,000 jobs,
Yeah.
I discovered the role played by, or learned a little bit about mortgage brokers who got paid for yield spread through yield spread premiums, which nobody ever talked about.
Right.
And so they have since been regulated to some extent
They have.
and required to register. So my question is, fine, that's good. They were the ones that were supplying the raw materials for the big securitization packages. But how about the guys buying houses in the Hamptons and the folks at the other end of what can be done to disincentivize them from blowing up the financial system with another round of securitizations or whatever?
Well, we could have done a lot more in that area. I agree with you. I think, the securitizers, right, so the mortgage originators, it started there, but they were getting funding from the big guys. And, there again, the uneven response. So DoddFrank had what was called a risk retention requirement to have a minimum 5% risk retention for those who securitize these mortgages. They had to eat 5% of the losses. So every dollar of loss to a securitization investor, they would have to take 5 cents of it. And I thought that was a good idea. I would have made it higher. But the regulators in the rule rating process, they basically just gutted it. And it's a very, very powerful industry. And then the rating agencies that also fueled this with these really high ratings that, you just looked inside them, you could tell these are all going to go bad at once. Nothing's happened to them. So, yeah, I think there are, fortunately the market has disciplined that a lot. So many investors got burnt so badly that people are still skeptical and scrutinizing of securitization pools. And I think the rating agencies took a huge reputational hit, even if they didn't pay for it legally and regulatory, which they should have. But that slowed them down a bit. But how long is that going to last? So yeah, but it was very uneven. I agree with you.
Yes, ma'am.
Something that came out of the financial crisis were the stress tests. And I was curious if you feel that the stress tests for U.S. banks are stringent enough.
Right.
And also, given this is a global banking system, what's your view about the stress tests in Europe?
Yeah. So I think the stress tests were positive. I don't think they're the end all to be all, but I do think they're positive. We had a very static examination process. When I came to the FDIC, all the bank regulators did. So examiners went into a bank, looked at the loans, looked at the assets. Are they performing? Are they delinquent? Are they not? And if they're performing, and the asset quality looks good, which is in good economic times, you're going to have low default rates, et cetera. Okay, bank's good, bank's in good condition. So nobody asked, well, what happens if the housing market turns? What happens if unemployment goes up? What happens if the stock market crashes? So, and actually, when I came to the FDIC, the deregulatory trend had been so strong that the FDIC itself, which is probably the toughest, I'm biased, but I think the tougher of the regulators, had instituted what the examiners, they hated it, they called it drive-by examinations. So if you actually had a good examination finding, they do the cycles on a yearly basis, the next year you didn't have to go out and look at their loans or anything, you just kind of did a drive-by. So you interviewed a few executives, looked at policies and procedures, and that was it. Well, that was dumb because, anybody can look good when the economy's good. So we got rid of that, but I think stress test institutionalized that in a very robust way for the larger institutions. And I think management, even though they're hugely, a lot of work, I think even management would agree that it's forced them to think through how strong their balance sheet really will be in a downturn and distress scenarios. I do think, though, too much reliance is being put on them. They're not, they're only as good as assumptions that the Fed is putting into their models. So the Fed publicizes the stress scenarios that they assume. So they'll say, the housing market goes down by X and unemployment goes up by Y. So they'll publish that. The public can see that. What the public can't see is how they're determining, that drop in home prices, how that translates into a loss on the bank's balance sheet. And that's where I don't have as much confidence, because I look at some of these loss rate assumptions, I'm saying, you think they're only going to lose that much? I'm a little skeptical of them. So we need belt and suspenders, and there again, your first line of defense is strong equity capital. Regulators are going to make mistakes. They're not going to be able to fine-tune those assumptions exactly right. They're probably going to undershoot if they do anything, and that's why you need a very, very strong buffer of capital to absorb the unexpected losses that will inevitably occur.
There's a question here. Student. Yeah. Oh, you.
Where would you like me to go?
Yeah. Yes. Here.
Hi, I'm Pranit. I'm a freshman at the college. I was wondering, even though the crisis was like a made in America thing, why did it impact the world so much? In fact, statistics say that the impact was larger than the 1930 depression.
Yeah. Well, so there's a really good book called Crash that I've just started reading it, but it goes through the interconnections, particularly between the US and Europe, right? So everybody was kind of all in on this mortgage thing. And actually, the European banks were investing these mortgages. They were packaging them and using them to back their commercial paper, which our money market funds were buying, right? So the whole thing was interconnected. Plus, and I think, that's really, it was those really two financial sectors that got hit. Asia, emerging markets were not, they suffered from the economic downturn that occurred, right? Because we import a lot of goods, so when our economy gets sick, the rest of the global economy catches a cold. So there was that impact from our economy slowing, but in terms of the financial systems, it was really Europe and the US. I think you also need to, and there were, a lot of this was being done in London, because London had a very light touch regulatory structure. So all these swaps, these credit default swaps are being written like AIG's operation. That was in London. And there was regulatory arbitrage there because it was very, very light touch and easier for the banks to do business there. The other thing that's, I think, interesting to understand about this is if we had just had to confront losses on the underlying mortgages. I mean, that was in the hundreds of billions. So it was big, but it wasn't enough to bring the system down. But it was really the trillions of synthetic products, particularly derivatives, that were piled on top of that created a lot of the problems. And, and then you combine that, so you've got these high-risk assets that are losing value very rapidly, thinly capitalized financial institutions holding their assets. It was a recipe made for disaster. But I really, in terms of financial instability, it was really Europe and the US. The broader world economy was impacted more by the recession that occurred as a result of the crisis.
Yes, here.
Hi, John Campbell. John Campbell, I'm in the sociology department. Sort of a follow-up to this one, because there was a contagion effect,
Right.
particularly into the West European financial system.
Right.
Are there any lessons that we should learn from how the Europeans handled this in terms of regulatory reform or anything else?
So I don't know that I've been, so the European banks are really on the ropes now. I think that has to do with a lot of things. So they went through their sovereign debt crisis, which again was generated by the weaker capital rules that they had in Europe. And so, we had something called a leverage ratio here. So that, firm amount of capital you had to have, no matter what was on your balance sheet, you had to have that much capital. In Europe, they only had what so-called risk-weighted ratios. And then if you invested in sovereign debt in Europe, you didn't have to have any capital against that. You could fund that 100% with leverage. And so that, the German banks were buying all this Greek debt. I mean, it was, because they could use 100% leverage for it. So they went through that. And then their economy, I think, they've just got a very bureaucratic governing system. They've never really properly integrated the EU. Now they've got Brexit. So a whole host of things have been thrown at Europe and the UK in a way that I think have weighed on economic growth and weighed on the financial system. So I would actually say the opposite. I think in the US, We forced our banks to recapitalize much faster. We had stronger capital requirements going into this. We have stronger capital requirements now, and that's one of the arguments being used by the big banks to try to weaken the capital requirements, that they're so much stronger than they have in Europe. Like, you know, European banks, there's a competitive disadvantage. JP Morgan Chase's revenue last year exceeded that of the 5 top European banks. The 5 biggest European banks together made less money than JP Morgan Chase by itself made last year. So they're really having a competitive disadvantage, you can tell. So I think, you know, I don't think they acted as forcefully as they should. And I think, and I say this, strong capital is competitive strength, not a competitive weakness. It may weigh on returns on equity, you know, and bank managers are some of the biggest equity shareholders because they get all their variable bonuses in equity. So they love all that juiced up leverage to give them higher rates of return. But if you're looking at a bank actually functioning and lending and providing support to the real economy, strong capital is absolutely, it's competitive strength, not a competitive weakness. So I hope, you know, European banks work their way out. But right now, I think actually that they're still struggling. And they have instituted stress tests. They have the European Central Bank is now the main supervisory authority. They have a resolution mechanism. They haven't integrated the deposit insurance system yet. They probably need to do that. So they've made some positive changes, but I think the key mistake they made was not forcing the banks to recapitalize quickly, and they've just continued to struggle.
More questions? Here, sir.
I'm Pete Lopez, a retired alum. Just interested in your opinion on to what extent the government pressure to increase mortgages in low-income and minority areas contributed to this crisis, and how is that situation playing out today?
Yeah. So that's a good question, a question that's asked a lot. And I think that was really used more as an excuse than a driver of what was going on. They were making a lot of money. That's why they were doing it. But it is true. Government gave them cover in a couple of important ways. So there's something called the Community Reinvestment Act. And it's important to understand that most of these subprime mortgages were made by non-bank mortgage originators, those mortgage bankers that were not subject to CRA. So CRA had no place to blank. That said, there were some thrifts. And we saw these when they failed. We'd go in and our IG would do a postmortem on these failed institutions. And they were handing out CRA credit for these awful subprime loans. I couldn't believe it. So, but again, I think that was kind of an excuse, a cover. It really wasn't a driver. They were doing it because they were making money. The other way that I think the government provided cover for this is they told Fannie and Freddie. So Fannie and Freddie, the mortgages they actually securitized themselves were pretty good credit quality. But what they did was they bought the lion's share of the AAA rated tranches of these Wall Street securitizations. Okay, so they fed that market. They provided the liquidity that allowed these big Wall Street banks to originate these high risk loans and be able to sell them into the market. And the government told them if they bought these securities, they would get affordable housing credit, which was, again, just, you know, encouraging and providing cover for some very problematic practices. So I don't think it was a driver, but I do think it was very ill-advised for the government to be kind of providing this patina of legitimacy, like they were trying to help, you know, low-income people have houses. The other thing I think is important to understand on that is most of these, not all, so we did increase home ownership by several percentage points. Of course, it fell down to much lower rates now. But most of these subprime mortgages, they were refis. These were not new purchases. These were people, a lot of them had 30-year safe fixed rate FHA guaranteed mortgages. They got refinanced out of these. You know, they were push marketed. This is what we were seeing in 2001. They were push marketed. Hey, I can get you a new mortgage. You know, sign on the dotted line. We can pull $20,000 out for your roof or, you know, whatever trip, whatever you want to do. They were an enticement, but they were not expanding home ownership. They were refinancing much more affordable mortgages by people who didn't really understand what they were getting themselves into.
Sheila,
So,
thank you for coming to Dartmouth.
I enjoyed it. No, my pleasure. Good question.